Well, thanks everybody for sharing your lunch hour, at least Kansas time with us. I know we have listeners from all over, so it may not be lunch everywhere, but I have the pleasure of being last on our series here. So thanks for sticking with us. I hope you found this helpful. I'm going to stay pretty broad in my remarks. I'm tasked to comment on the livestock and meat situation. I'm going to do that with you here for a few moments. I think it's important to set the stage. I have the term up here. What was the situation here, at least here in the U.S., for the meat and livestock industry before the conflict? So if you want to have a specific date in your mind, February 24th was the date of the invasion, at least in the eyes of most of the world. Russia entered into Ukraine. So from that date forward, the first 6 weeks, if you like, of 2022, what was the situation? And it's important to note that there was multiple things leading to higher livestock prices. First and foremost, we had smaller herds. So the cattle herd is in the midst of being reduced, and actually hog herd as well. Some updates from USDA in the last few months are part of that. So we had supply side price support for livestock prices early in 2022, again, before the conflict. We also had, and I'm going to belabor this point for the second half of my remarks, a lot of meat demand strength that was also supporting livestock prices. So here domestically, as well as foreign demand for U.S. meat, was adding additional support. So if you had smaller herds as well as strong meat demand, both of those were pulling up livestock prices, and more generally the expectation that livestock prices were going to be higher than they were in 2021. It's important to keep that in mind because we already had that underfoot. There's a lot of discussion and controversy around consumer prices on meat, and we can come back to that in the Q&A if you like, but I'm giving you this kind of backdrop to set the stage for even before the recent elevated discussions and inflation and so forth. We had strong consumer demand as well as shrinking available supplies. They're all part of that story. We also had well-documented drought patterns. Most of you know, at least for cattle, the cow-calf sector spans multiple states. Of course, feedlot and packing sectors more here in the middle of the country. But the impact of drought in the West, and the West is a general term, it's not just a California, really throughout the Rocky Mountains. And you could even just stop with the West, because even here in Kansas and the Dakotas have pretty well documented drought concerns as we entered into this conflict. You couple that with some other things in the grain markets, livestock producers were definitely facing higher cost of production as we entered 2022. So that distinction is important because Econ 101 is we need to understand both revenue and cost to have a handle on what kind of net margins or profitability might be. So despite the fact that I was pretty confident we're going to have higher livestock prices before this at least latest shock, I wasn't as confident we're going to have elevated margins for producers because there's a lot of uncertainty on the cost of operating production cost front. We also had, I'd be remiss if I didn't remind everybody, some evolution that's happened in the last 2 years is there is some adjustments in the tools and increased subsidy in the case of some products for livestock producers that are interested in price risk management. I'm not going to make this a full price risk management talk. I don't have time for that, but I wanted to at least put that up front. We've talked about that in other settings. My colleague Jenny Ift continues to work in that arena as well. And I'll include here, there's a link to a full, mainly beef and cattle focused Outlook slide deck that was dated end of January. You could look at that to get a belabored version of this pre-conflict situation. I share that to set the stage for the next couple slides here. When I'm asked what is the impact of the Russian-Ukraine conflict, I find it helpful to separately look at the futures markets from the cash markets. The benefit of the futures markets is we have a value at any one point in time for an asset at a future point in time. So please note up here at the top here, I've included values for CME contracts. And I purposely picked April and October because it's available for live cattle, feeder cattle, lean hogs, as well as class 3 milk. So it's convenient to use as a either nearby or close to nearby contract, is the April one in this case, as one that's more deferred. And you can see I've included 5 rows here. So a couple earlier in the year dates, Wednesday, January 5th, Thursday, February 17th. And then in the middle, I'm giving us that Thursday, February 24th, kind of the day the conflict officially started, if you like. I put it in bold. And then 2, more price snapshots since then. So last Friday was the 4th, and then settlement values for Thursday the 10th would have been last night is the last information that's here. I give you all that information. You guys can read the specific numbers, but I'm trying to drive home the point that prior to the conflict, so I think the first 6 weeks, we were seeing small increases in live cattle prices, a little bit of a decline in feeder cattle prices because the corn market was already rallying. So if you piece together what I have up there, I have the same thing for the corn market, and I've included the equity market, the S&P 500, if you want some other kind of traction was going on. We already had some concerns on the general macroeconomic environment, some concerns on the feed cost environment. So I include corn here, even before Russia formally invaded Ukraine. And those concerns have been magnified since then, of course. So if we go forward, right, what's happened since February 24th, you can see the nearby live cattle, as well as feeder cattle, as well as lean hog prices have all pulled back quite a bit. The deferreds haven't pulled back as much, and that's not surprising. I mean, there's some similarities here to what Dan was sharing on the nearbys versus deferred wheat market that he belabored a little bit. You can think the same thing is there's a lot of certainty that we have disruptions now and in the next few weeks, less certainty about what the disruptions are going to be later in the year. And in some sense, the current traders, they aren't beating up the livestock markets out this fall, this winter, as much as they are the nearby markets. I said I like to look at both the futures and cash market. So I've included here a similar summary of the spot cash market separately for live cattle and feeder cattle, and then for two different groups on hogs, both market hogs as well as early wean pigs. And there's a different story depending on the species here, is why I do this here. And just to round it out again, I included some Garden City corn quotes. Again, please note corn went up by about $1 from the start of the year until we got to February 24th. And it's went up more since then. Dan noted that properly earlier. Fed cattle prices were increasing and feeder cattle a little bit the first 6 weeks of the year. That was reflecting some confirmation, tighter supplies and demand holding up a little bit better than we thought so far, and some positive spillover on exports that I'm going to belabor in a moment. But the real action was the rally in the hog market. So if you look here in the middle of this chart, barrel and gilts, market hog prices were up notably from the start of the year to that point, February 25th, 24th. And I include here the 25th because daily prices in some assets are pretty thin. So sometimes when you pick a different date, it's closed. And then some of that bullishness on the market hog side has spilled over into bidding up of lighter weight. So for those that aren't familiar, 10 to 12 pound pigs is generally the weight when you have pigs weaned from a sow that goes into the finishing nursery and then finishing stage. But what's happened since then in the spot market, you can see fed cattle prices, they've lost about $6 since the invasion. Feeder cattle have lost more like $11. It's not surprising feeder cattle have been beat up more. Feeder cattle prices tend to be more immediately impacted by grain prices, and we're definitely seeing that show up. We have not seen the same pullback on hogs, and I think this is where the tighter supply and sort of the affirmation of tighter supplies on the hog side has come into play. There remains some optimism that we're going to sustain exports on the hog side with some of the disruptions, and we haven't, at least so far, seen that market impacted the same as we have, particularly the feeder cattle market. I've included this slide half a dozen times in the last couple of years. I mean, I fully recognize it's dated, but I'm doing it for a reason. We're sitting here in March of 2022. I don't know how many quote unquote black swan events we've had. That term is definitely way overused. I think a more accurate term would be unexpected events. Some of them are geopolitical, like we're mainly talking about today. Some of them are infrastructure, and that's one that's right here. Is if you don't remember, August, I believe it was 9th, and it was early in August of 2019, outside of Garden City, the Holcomb Tyson plant burnt. And there was a lot of discussion and controversy and interest in that event. I've included a snapshot of how the live cattle October contract, as well as the feeder cattle October contract, behaved going into that August, like I said, about 9th period, and then how we what happened between then and when we got into actual October. Please note the limit down on live cattle, the big gap on the lines that happened, and the notable decline as well on feeder cattle. And then note as we got closer to October, there's a recovery in both of these assets. Why am I highlighting that? I think it's important to remember that markets, and in particular futures markets for some future point in time, I think can be described as working like a pendulum. They reflect our best assessment of supply and demand and other related fundamentals at the point that people are executing trades. But that's not perfect information, and certainly future environments can change. When you have a risk elevation or an increase in uncertainty in a market, which happened in a smaller scale with the Holcomb event, is why I'm including it, it's not uncommon that we see markets like, in this case, live cattle and feeder cattle, get bearish, right? In this case, there was a loss of the ability to harvest cattle to the tune of 5 to 6% of the industry's capacity to do that. That was not favorable for market-ready live cattle, and it spilled over into concerns about backing up cattle and feed yards and depressing demand for feeder cattle. Markets work like a pendulum, and I think we're seeing that in spades. albeit in a much larger scale, first with the COVID challenges that we're not totally out of the woods on yet, and then more recently, the Russia-Ukraine discussion we're here to talk about today. I include this slide, and Dan did a really nice job of setting the stage for what's going on more generally in the grain price arena. As the livestock and meat guy here, I immediately put my head on, what's the feed cost? What's the cost of a ration mindset? Most of this is pretty straightforward in the near term. So think the next few weeks, maybe the next 6 months, if you want to say near term. In a general sense, short term would be the term economists sometimes use. I think we almost certainly have elevated ration cost. And the net result of that will be is it pinches margins for most livestock producers. So to date, we have not seen output prices keep up with input prices. So that's the net result. Another thing I think is likely is, again, over the next 6 months at least, is we may see lower finished weights. I put here most likely because that's driven by lots of things. In the cattle space, we have more and more cattle sold on the grid, so that can nudge those towards certain finish types and premiums. All these things are interconnected. But overall, I think we're going to see lower finished weights. We were anticipating slightly higher finished weights for cattle and hogs compared to the year before. That's probably not going to be the case now. They might be flat, if not down, from the year before. And that itself will take a little bit of meat off the market here in 2020.
Maybe while we're waiting for Glynn to get back, somebody asked a question with regards to what the acres were produced in. And so I pulled up the arable land. In terms of the arable land in Ukraine is 32.9 million hectares. And the 2020 harvested hectares, and so you could lose some of wheat were 6.5 million hectares, sunflowers 6.4, and you can kind of go down, but essentially you can see that the three major crops are kind of wheat, sunflower, and maize with regards to acreage allocated. And then barley's in there, soybeans are in there, in potatoes. And again, these are acres harvested, not acres planted. These end up being about 75% of the acres harvested. And so hopefully that kind of answers the question that somebody had with regards to crop allocation. But at least in 2020, that's kind of the numbers harvested. Is Glynn back yet?
Rich, while you're waiting, can I ask Guy Allen, as on that basis issue? I know you've dug into that some. While we're waiting for Glynn to come back on, do you have a comment on that?
Yeah, I might comment just further on Alan's on the Ukraine situation. What I'm sort of picking up out of the Ukraine is a couple things. One, if they do plant crops, whether it's spring wheat or next fall summer crop, it's likely to be probably more wheat than corn or other crops. It's easier to put in, takes less inputs, and it's a lot easier to manage. So probably see a swing that way. Also, the big concern is just, there's a good volume of people that have left the Ukraine. I think it's approaching 10%, over 10% of the population and more. And all the able-bodied men of military service age are currently engaged in other things. And the comment coming from an international person is, at the cessation of conflict, it would be minimum of 60 to 90 days before they get commercial things back into order, let alone before you think about turning to planting your farm and this and that and getting supplies. So my biggest concern is extends not so much on the nearby immediate supply of grain, but next year, this coming year's production. And I think, Russia and the Ukraine both attempt to shut down exports in order to secure domestic food supply, and control domestic food inflation is a high likelihood. And even no matter what they do, I don't think those supplies will be immediately available to the marketplace. Leading into that.
There is a question here with regards to barley. Do you know whether or not the barley produced in Ukraine is food grade or feed grade?
Both goes into malt and to feed. And the way I've sort of calculated that, I think there's about 10 million tons of barley exports. I'd have to double check that off the top of my head, but I've sort of been substituting corn as a 1-for-1 replacement into that. The biggest buyer of that barley is China, and that's both as feed and malt. But I basically, you're going to put corn in that substitute probably ton for ton. And that's why I've calculated it into the balance sheet. Simple way to do it. But that barley component is it's a big part of that coarse grains complex.
Any other questions that we can take for people while we're waiting for Glenn to come back? I'll give Rich a break here in terms of, I'm sure he's working on the technical side, so I'll kind of take over as moderator here for a little bit.
Could I address Dan's question then on the cash prices and basis?
Absolutely.
Just some comments on that, and this comes from my experience as sort of managing country elevators and international trade book. I think the thing, particularly from a grower perspective, we need to keep in mind, merchandising in an inverted market is extremely difficult, let alone extreme inverses, which we have. And that inverse, i.e. the nearby price is higher than the later price, that extends all the way across the futures price structure over 2 years forward. And what that means, it comes down to a logistical equation. And if you want to capture that nearby premium, you have to have equipment and the ability to execute. And what I picked up from the U.S. country elevator guys this week is there's just no equipment available. So one, if the grower comes in and wants to sell cash grain immediately, one, can the elevator execute, i.e. can he get rail equipment? And there's no offers in that secondary rail market. It's being bid at $1,000 a car or more premium, but there's no offers out there all the way out till June, July. So he can't get rail equipment. Then he has to have a train load or a barge load or equipment ready to execute against that. And what's really driving that big inverse in the futures market, particularly corn and beans, which are river delivery, is that demand that's coming into export. And we've had basis values at the Gulf at delivery values equivalent, i.e. it was as economic for the exporter to buy futures rather than to buy cash basis for some time, the last few months. So we're once we get that basis to delivery value equivalence, futures has to do the work. So it makes it very, very frustrating. So rolling your underlying futures month, reference month forward to new crop July for wheat is the obvious thing to do, or even moving it forward, because even today we're looking at a 35 to 40 cent inverse even between July, September futures. So if you can't execute, big penalties in that market for not having nearby ability to execute through that supply chain.
Well, Glenn is back. There is one more question on pulse crop markets. Maybe while he loads his slides, Guy and Dan, the comment is, this is certainly minor acreage, but is there potential impact on the pulse crop markets? Is Ukraine a player in peas, lentils, and chickpeas?
Yes, it is. I understand that more from an Australia perspective, and those commodities have a very high value at the moment. The biggest challenge for that particular market is most of that's executed in containers, and you want to talk about supply chain disruption. Getting containers into there is extremely difficult. So yeah, it's and the demand for those particular commodities is particularly the Middle East and Eastern Mediterranean areas, particularly, as well as India, Bangladesh, et cetera. And it's just again, it comes down to an execution challenge on that. But there should be good premiums across the board on that.
I just wonder about logistics and finance, logistics of getting inputs and or products to different locations in the country. There's such disruption, and what's their financial system now? What would they be? How are they going to borrow money to put crops in with such monetary and financial system disruptions? I saw Sam Funk, appreciate his comment. Yeah, there'll be challenges all the way into 2024-25. When this shakes out, what will be the governing structure, and what will be the business environment? And will people be able to function? I think they're all questions that are up in the air now with Ukraine.
Yeah, well, particularly what currency are they going to be operating under? If they're operating under the Russian ruble, the devaluation in that has been significant. And then what's their capacity to obtain any sort of financing for production? It's just, yeah, good question.
Let's get out of the way now for Glynn, as we've, I think it's time for him to go.
Okay. Thanks, guys. Appreciate you filling that in for us. Glynn, I think we're ready for you.
You can hear me. I've been kicked out of Zoom 3 times while you guys were filling for me. Can you see my slides again?
Yes, we're back.
All right. Very good. Let's see if this works better. If it doesn't, I'm just going to kill the slides and just talk. So hopefully that is good. Does that look right?
Yeah, we're good.
All right. Very good. So the point I was trying to make, and I apologize, I don't know exactly when it froze and kicked me out the first time, is, Dan set the stage very well for feed costs. I think that's all straightforward. I think there's uncertainty tied to one of the questions that Dan got in the first chat post was, we're going to plant more wheat here in Kansas. I would encourage us to recognize that even if we do, it's not a foregone conclusion that we're going to graze more from a cattle perspective. The ultimate decision about whether we graze cattle and whether we graze the whole crop out versus put the cattle on for a little bit and then kick them off has to do with relative price between feeder cattle and wheat. So I think there's a decent chance, if you listen to Dan, that we might have additional wheat acres, but that doesn't guarantee we're going to have more grazing occur. So we need to watch the relative price of feeder cattle to wheat as this continues to play out. I want to spend a little bit of time transitioning from the feed cost impact to the other side of the equation. So I planted the seed, and hopefully everybody picked up on this, on the role of meat demand and what that does as a pullover for derived demand for livestock. I've included here a table, and it's not a sexy table, but it allows me to make a couple of key points from research I did with Jason Lusk, my colleague that's at Purdue University, and then Ted Schroeder, who's also here at K-State. This is Beef Checkoff funded work. You can see here a link to the report. The report was actually done in January of 2018. And I want to make 2 key points here that are directly relevant for this. First is, we have found over time that U.S. meat demand is more sensitive to the income environment, I think more generally the macroeconomic environment that consumers operate in, than it was 20, 30 years ago. So in econ geek speak, the income or expenditure elasticity has grown. The importance of consumer finances has grown. Why am I highlighting that here? And it's an important research finding, but it's timely because I would argue a big part of the bigger story for Russia-Ukraine conflict is what's happened to the global economic situation. So how much of a reduction in global GDP and consumer sentiment are we going to have? Not to mention the erosion of buying power with inflation and so forth. So exactly how that macroeconomic shock spills over into beef demand, and it's not just beef demand, it's pork demand, poultry demand as well, is really worth watching. Beef demand is the one that's most sensitive to those income effects. This has been a good thing early in the pandemic because consumer incomes actually improved, in no small part due to federal subsidies and stimulus, and of course, but that helped us have stronger beef demand in particular. Well, we need to be aware that that same mechanism of consumer finances having a bigger role might work against the beef industry as this plays out. There's reason for optimism because we're starting with a really good demand story that I'm going to give you some evidence of, but I'd be remiss if I didn't highlight that here. It's also important to note one of the reasons we've sustained strong meat demand is own price effects have declined. So again, I'll try to keep it fairly jargon free, but the amount of beef or pork that consumers buy is not impacted by the asking price of beef or pork as much as it used to be. So please note, price still matters. Don't overreact to my comment, but price sensitivity has declined compared to the past. I think taste, safety, eating experience, some of those non-price factors have grown. And in this long report for the beef industry, we belabor that. But it's really important to understand those dynamics is there's an increased ability to pass on higher prices as long as consumers still view that product as giving them a high quality, enjoyable eating experience, as long as their general finances in the general, macroeconomic environment holds up. So there's a lot that goes on to the domestic demand front. There's a lot of things to watch there. I'd be remiss if I didn't belabor this because it's not just the feed cost effect. The ultimate revenue side for livestock producers starts with meat demand. For those that want more information on this, I'm going to speed this up because I lost some time fighting technology, is the Meat Demand Monitor is a project that's housed here at K-State. It's funded by both beef and pork checkoff partners. I encourage you to make use of that. It's an ongoing survey effort. Lots of data and information on the domestic demand front is there. I've included a few charts just to kind of bait you to come watch that if you like, and allow me to make a few broader points. is the last 5 or 6 months of 2021, meat demand in general and beef and pork specifically was stronger than it was when the pandemic started. So I'm including here 2 different charts for beef demand. The one on your left is about ribeye steak, both retail or grocery store, separate from food service, which is restaurants, as well as the hamburger product. So 2 different beef product types for 2 different market channels domestically. You can see the general trend on all these lines is up from when the project was launched in February of 2020, just by accident, corresponds right before the pandemic started. But what I really want to impress on you is we started 2022 with very strong domestic beef demand, and the same statement holds for pork. So this is a similar slide. On the left is for pork chops, and on the right is separately for bacon and baby back ribs. We have 2 different products because you don't just get a bacon meal. So you have a separate food service item there for pork. But you can see pork chop demand, the second half of 2021 was well above where we were when the pandemic started. And the same statement holds for bacon and baby back ribs. This is important because domestic demand for meat is quite strong. The ability to absorb some higher prices, I think, is elevated because the public wants beef and pork in their diet. I also track in this project what consumer expectations for meat prices next month will be. And going into the conflict, so please note the last bar here corresponds with data in February. So this is an ongoing effort. The March survey is out. It's active as we speak. And I've been doing this since last March. And there's been a lot of discussion about inflation and specifically retail meat prices that I'm honing in on here. Consumers' expectations on prices appeared to have peaked around November. And that kind of played out. We have seen a little bit lower prices the last couple months, consistent with that. But it's worth watching whether or not the elevated fuel prices and more generally inflation is going to spill over into higher cost of producing meat that leads to these prices coming back up. If meat demand holds up and those higher costs come into play, then I would certainly anticipate us to not have peaked in November. But in 3 or 4 months, we look back on this, consumers might have higher yet retail meat price expectations. That's a domestic commentary. We're talking about a global, a conflict outside of the U.S. in Russia and Ukraine. And again, I'd be remiss if I didn't remind us how globally connected things are. I include here a link to a fact sheet. If you guys want to read this more completely, is I try to measure annually how concentrated the beef and pork export portfolio is. And what I'm doing here is basically just calculating the equivalent of a concentration index. So you might be familiar with the Harfendahl index. I can explain in the Q&A if there's interest how I do this. But the punchline is the portfolio of countries that the U.S. does business with, that sends beef to as well as sends pork to, is much more diverse than it was 20, 30 years ago. You can see the hiccup around BSE where we basically lost all the Asian markets. That shows up in the middle of this chart for beef. But it's really important to recognize that the U.S. has many customers outside of the U.S., and it's not as reliant on any one country as it once was. That's not to say it's free. You have multiple sources of exchange rate risk and so forth we could talk about. But I think there's a natural hedging benefit to that makes the shocks like Russia and Ukraine and so forth a little bit less challenging than they would have been 20 or 30 years ago when both industries were more reliant on a small list of countries. Beef trade in particular has been really important the last 12 months. There was 3 months in 2021 that the U.S. exported over $1 billion worth of beef. And to drive that point home, USMEF, so United States Meat Export Federation, estimates about 22% of the average fed steer value in 2021 can be tied back to exports. Why am I giving you that? I think it's very easy to only focus on the feed cost impacts, and they're real. I'm not trying to ignore them, but I think they're pretty straightforward. The combination of Dan's remarks and briefly me just commenting on how they tie in here, hopefully straightforward. There's no doubt that feed costs are elevated and probably going to stay elevated. But equally importantly, and the reason I'm just allocating a little more time to this, is the meat demand situation. So we started 2022 and we went into the Russian-Ukraine conflict in a pretty good position, but it's certainly worth watching. I put on here, there's some storm clouds building. Perhaps my biggest economic concern, not human concern, but economic concern is, are we going to see ongoing retreat from global connections? So I tried to drive home the point that exports has become more and more important. I can do that longer winded than I have here if we want. But ultimately, if we continue to step away from global trade and more generally the notion of globalization, and there's lots of things on the horizon even before the Russian-Ukraine conflict that suggested we might do that, that leads to the U.S. meat and livestock industry operating in a smaller world and by extension has a smaller industry. So that gives me notable concern. Simple statistic being 22% of the value of fed cattle coming from exports gives you some insight on how important that is. My last comment here, this is actually just pulling a quote that wasn't about Russia and Ukraine, but I think it still applies. I did a long interview series of Meeting Place back in November. Here's the link if you want to pull it up. There's a lot of angst in the U.S. meat and livestock industry that had nothing to do with Russia and Ukraine, and lots of governmental proposed policies and the like. I included some quotes that were suggesting that good business plans as well as government policies need a clearly stated goal. And at times, I think we have multiple plans and multiple policies that are kind of self-conflicting. I'm reminding of us that here, because I hope all parties, and I know we have some various industry leaders are with us here today, is why I'm interjecting this, take some pause on very protectionistic responses. Learn from history that when countries start self-protecting their grain stocks and the like, that shrinks the world. It shrinks the economic potential of our domestic industries. And that has become a bigger economic driver of current markets for livestock producers. And certainly, at least in my opinion, is a key part for their future success as well. So I get quite concerned if we hunker down too much, even though that is a natural human thing to do. Rich, I purposely sped up because technological issues cost me some time, but I'm happy to take some questions and clarify things now.
And there were a couple that I sent you direct message in the chat, or I can read them to you if you'd prefer. I think you should have them.
Why don't you read me one while I pull them up?
All right. This was just as you got knocked off. Even though total cattle numbers are coming down and front end supplies and feed yards are smaller, total numbers in feed yards are still such that it seems we can't market enough cattle to make weights come down. That was exacerbated by the mild winter. Question is, with this feed situation, when do you think we reach a point that these feed prices will push carcass weights lower?
Soon. Is that precise enough? So the feed price impacts are real, right? I mean, Dan belabored this and so forth, is if you've got cattle that are, still going to be on feed for more than just a couple of weeks, it's going to have a real impact on your per head return of paying $1, if not $2 per bushel more, right, for the corn than you were thinking. So I think we're going to see that direct impact on feed cost happen fairly quickly, and that'll start pulling down the weights.
And then there was a follow-up question from someone else. Second, Michael's question about timing of corn prices showing up in dressed weights. Take it a step further. Your thoughts on timing and magnitude of impacts to beef prices?
Yeah, so maybe I'll go grab my notes here. I had separate because I purposely didn't do a full outlook talk. For those that want related details, this is a plug for last week's program. So last Friday, the Animal Science and Industry Department hosted the Cattlemen's Day event. My slides are there. That's a more full outright, outlook talk. For those of you that have similar questions, please go there. What I shared at the time was an LMIC forecast, which is Livestock Marketing Information Center, that was dated March 1st. So that would reflect, at least at that point in time, the early effects or expectations from the Russia-Ukraine conflict. Dressed weights were going to be up about 0.5%. That's generally across all 4 quarters. Some were up 0.4, some up 0.6% compared to the year before. I think we very likely are going to push that to flat, if not negative, given the current feed cost environment we're talking about. So how fast? Obviously the first quarter is almost done, so we're not going to change that net first quarter number. But by the time we're talking the second quarter here of 2022, I think we may have flat, and certainly we get out into the third and fourth quarter, we'll have negative compared to the year before.